pieces are doing well right now. Gautam Duggad is joining us. He's the head of research at Motilal Oswal. Gautam, good morning. Thanks a lot for joining us. Early days yet, but looking at the earnings and looking at the kind of tailwinds that we have started to get, especially with the decline in commodity prices. What's your view, especially in the consumption piece?
Yeah, hi Anuj. Good morning. Yes, early days. In fact, the earnings season has not even begun yet, except for 2 or 3 IT companies. The point you referred to, which is the moderation in commodity cost, I think it augurs quite well, though the benefits may not be visible in the results of this quarter. But crude and some of the other industrial commodities and packaging cost, they have corrected a lot from the top, of course. Assuming they sustain this moderation for another couple of months, then clearly Q1FY23 and then subsequently in the second half of FY23, we might see some pickup in the margins. Because we also need to remember that in the last 3 months, several of these consumer companies and even the discretionary names and auto companies, they have passed on some of the input cost inflation that has been witnessed in the last 6 to 9 months. So combination of moderation in commodity input cost and at the same time the spillover impact of the price hikes which have already been implemented, that should help some of these B2C names. And which is why after 2, 3, 4 years of time correction, we have seen some of these stock prices moving up finally in the last 3-4 weeks, the moment commodity prices started correcting. But yeah, I mean, this quarter you might see some growth because of the low base, which is actually the case for the entire coverage universe for us, where on a low base of June 2021, we are seeing about 30% earnings growth for Nifty, 21% for our coverage universe. Sequentially, things are going to look quite weak at about 7 to 12% sequential profit decline for both Nifty as well as our broader coverage universe. So that's why we are looking at things from a 3-year perspective, pre-COVID, June 19 to June 22. There things look quite good at about 22% earnings CAGR for Nifty and similar kind of a number for our broader coverage universe, of course, led by commodities and financials.
Right. And we'll, Gautam, hi, we'll talk about individual sectors and earnings growth expectations. But just to get an overall number, I remember last time you were on, you were, correct me if I remember this wrong, but you said expectation for the Nifty is 1,000 rupees and potentially there's perhaps a 10% downside. How has that number moved for you?
So Prashant, yeah, good morning. For FY23, we are still about 860, 865 range. There has been no cut. And FY24, we are again at 1,004 rupees. So there has been no change. So what has happened actually between April and July is we have seen earnings cut in several sectors. So cement, metals has seen a 30% slash because of the commodity cost correction and higher input cost. But all of this got overcompensated by the upgrades that we have seen in oil commodities. And of course, the upgrade in Reliance numbers. Had it not been for the export duty and windfall tax that the government imposed 10 days back, you might have seen 2 to 3% earnings upgrade for Nifty. But because of that export duty imposition and windfall tax, there is no earnings upgrade as such, but at the same time, there's no earnings cut. So the numbers that got cut in Hindalco, Tata Steel, JSW Steel, etc., all of that has been more than compensated for by just the upgrade in Reliance that we have seen. So net-net, we are still at about 860, 865 rupees for FY23, which translates into a 18% earnings growth and about 14-15% earnings growth on FY24 basis at about 1,000 rupees of EPS. Just the component which are going to drive this in FY23 are changing at the margin. So auto was a big drag for last 3 years. Now it is going to contribute significantly on a low base.
Okay. All right. Hi, Gautam. Morning. It's so good to hear this 1,000 rupee mark. I remember there was a phase between 2015 to 2019. I think I used to keep calling you up and we used to wonder whether it was going to be even single digit. But now that, 13 to 18% that you're talking about. But last year, I think we ended around maybe 750, 760 rupees on the Nifty.
736. 736.
736. So around 740 rupees approximately. Now that 740 is going to around 1,000 rupees. So
in 2 years.
In 2 years. So by FY24. So my question to you is, which are the top contributors in that 250, 260 rupees odd? If you could list down maybe 2 or 3 stocks. So those will be top of mind when we're tracking earnings as well. Go ahead.
Yeah, so I mean, look, Nigel, FY24 is too far. The kind of environment that we are living in, every 15 days, there is a change. You know, whether it is on the currency front, commodity front, bond yields, I mean, things are changing very rapidly. So I won't emphasize too much on FY24 numbers just yet. I'll wait for a couple of more quarters before I make FY24 the anchor.
Okay.
Right now, it is important to keep your expectations concrete around FY23. So if I look between FY22 and FY23, the three sectors which are driving more than 100% of the incremental growth is financials, oil, and then auto. So these three sectors together account for more than 100% of the incremental growth. Everything else, the rest of the 13 sectors put together at the margin are a drag. Metals being the single largest drag in FY23. Do remember that FY21 and FY22, metals was the single largest contributor. A sector with a 3.5% index weight accounted for almost 1/3 of the incremental earnings in FY22. Now that is giving way to auto, which has been lying absolutely decimated for last 5 years. So auto sector's profits, peaked in FY18 at about 30,000 crores, and then it went down to about 8,000 crores in FY22. We are expecting it to go back towards 30,000 crores in FY23. So, of course, a lot of it is also a base effect and the volatility associated with Tata Motors, but that tells you the picture at the year-on-year level, who's contributing and who's not contributing. So FY23 right now is the more prudent way of looking at things, and FY24 will evolve as we move forward, depending on where commodity prices settle, how the commentary turns out from the corporates in the next 6 months, if there is any lagged impact of the higher inflation, which has been very sticky now for the last 7-8 months.
Okay. Gautam, what about Reliance? How are you approaching it now? I mean, have you made any earnings tweak because of that windfall, tax? Or do you think, in any case, the market had not factored that in, the windfall gains itself in the first place? And if you could help me understand, in terms of earnings, how you position yourself on Reliance?
So, Anuj, we had not raised our estimates before that windfall tax came. So, we had not factored in those elevated GRMs. So our EPS was about 110 rupees, if I remember. And now, after this whole announcements from the government came, when we rejigged our number, our EPS stands upgraded to about 129 rupees. Now, look at it other way. If this duty was not imposed, then perhaps the upgrade would have been much higher for Reliance. So we now stand at about 129, 130 rupees of EPS for Reliance. As far as stock is concerned, I think now GRMs are settling down to a far more normalized level. Our assumptions for FY23 are around $14.5 per barrel for Reliance GRM. But as always, I mean, we have seen in the last 3 years, the biggest driver for Reliance off late has been what is happening in the other two businesses. And there are a lot of events and a lot of announcements which keep happening in the stock. So as far as we are concerned, right now we are positioned as a minor underweight in our model portfolio. We have about 8% weight versus 10.5% for Reliance in the index. So that is how we are approaching. Of course, after the recent correction, stock offers some upside now. 2 months back, we were struggling to find any upside in Reliance at about 2,700, 2,800.
What about ITC? That's been the other stock which has been the talking point. It's really been the biggest, index stock this year.
Which one?
ITC.
Yeah, so Anuj, for ITC, we've had a very neutralist stance for almost 5 years. I remember in July 2017, when we downgraded the stock, the price was 285. And we have turned positive now after 5 years, a month back. So when we again upgraded a month back, the price was 264. So essentially for 5 years, the stock has done nothing. What is the driving force are two factors. One is the fundamental earnings. So for 5 years between FY17 to FY22, the earnings CAGR was 5%. And now we are expecting about 14% between FY22 to FY24. So when I talk about those 5 years, there were, I think, 25 or 26 quarters where the cigarette EBIT for ITC had grown in single digits. And in my view, that is the single largest catalyst for ITC stock price performance. Whenever cigarette EBIT has grown in a good double digit, the stock has really done well. If you look at the pattern of last 20-25 years, we are now finding the cigarette volumes recovering at the margin. And third, last but not the least, the madness around ESG angle has moderated a bit. So we have seen a lot of stocks which had bore the brunt of ESG has started doing well. So these are combination of factors. And of course, at the end of the day, the valuations, despite the recent run-up, are still looking quite reasonable, with about 3.5 to 4% dividend yield and almost 100% kind of a payout ratio and 14% earnings CAGR for next 2 years. So I think stock looks decent even from these levels. We have reintroduced ITC in our model portfolio after almost 5 years again.
Gautam, any thoughts on the entire roads sector? I mean, when we talk about capital spending picking up, etc., everything gets mentioned except roads, although growth there has been pretty steady. By the way, we are also speaking with the road secretary on the other side in just a bit from now. But what are the catalysts to your mind, and what should investors really watch out for here?
So I think, Prashant, if you look at the last 2 years of budget announcements, the overarching theme of the union budget has been the capex, right? We are almost seeing a 7.5 lakh crore of capex that is going to be spent, which of course comprises of other sectors also besides road. Secondly, if you look at the execution of the construction of roads in the last 8 or 10 years, it has gone up massively on a per day basis as well as on an aggregate basis. The problem, however, with the sector has been that the number of investable companies have shrunk a lot. And this not just the case with the road sector, I'm saying broader EPC, construction, and overall capital goods space also. If you compare it with the cycle of 2007-8 and now, you will find that the number of investable ideas in the space has shrunk. From a broader capex revival point of view also, we are in the camp which believes that while at the margin you might see some improvement in the capex, but given where the capacity utilization numbers stack up across different sectors, there's not going to be any meaningful major revival just yet on the capex side. So, till the time you see the numbers reviving on the broader capacity utilization across sectors, I don't think the capex-oriented stocks and sectors are going to fly very significantly. At the margin, you will definitely keep seeing sub-segment and micro-level announcements driving the stock prices here and there. But from a very broader capex revival point of view, I think FY23 is not the year where you are going to see meaningful change in numbers. Stock prices can do what they have to do.
By the way, just look at the market, 16,050 now on the Nifty. So there's some aggressive short covering which is happening now. I just want to point out one stock though on the downside, Birlasoft. Just look at that stock. It's down about 4% now. In fact, the entire mid-cap IT pack, Mindtree started it 3% down, and Birlasoft is the one which is now approaching 3.5–4%
It's also
decline.
part of the F&O list, right? I mean,
Sorry?
Birlasoft is part of
it is part of the F&O list, and what's interesting is the futures is not down as much because there was a bit of a discount which was prevailing till yesterday. That discount has got trimmed, but still the stock is down. Gautam, mid-cap IT, this is one space which made you so much money. I mean, you as in the people in the market made so much money last year, and now we have seen a brutal decline. A lot of stocks are down 40 to 50–55%. How are you approaching this space in terms of earnings, and what would be your top picks, if any?
So Anuj, let me point out 2 or 3 things. We used to be positive on mid-cap IT. Overall, our stance on IT sector has been very positive for last 3 years, starting the beginning of 2020. It still remains about 200 basis point overweight. But somewhere about June, July 2021, we had removed mid-cap IT completely from the portfolio. An entire weight of 17% is allocated towards the large cap IT. The problem is twofold. One is, of course, the valuations, which were trading at 30–35% premium to tier 1 IT, despite slightly inferior payout and capital efficiency and free cash flow matrices. Second, generally for mid-cap IT, we have seen, if you look at the last 20–25 years of relative valuation movements, every 2–3 years, mid-cap IT gets into a discount and then gets into a premium. I think about 6 months back or 9 months back, the premium was clearly unsustainable. Even now, despite the correction of 30–35% or maybe even 40% for some of the mid-cap IT names, the valuations on a relative basis are still not offering comfort versus the large cap. On an absolute basis, of course, they have corrected. And lastly, from a fundamental perspective, the client concentration risk and therefore the ability to maneuver the margins with pricing is slightly lower for mid-cap compared to the tier 1 IT. So when tier 1 IT is also itself available at a valuation of 17 to 22 times, our preference is overwhelmingly towards large cap IT. We're still not finding comfort on the mid cap YT valuations.
Got it. Gautam, it's a pleasure. Thank you very much for joining us. It's always great speaking with you and insightful across sectors.